All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Hi, and welcome to our latest Fast Five. My name is Greg Thompson, Vice President Wealth Advisor with RBC Dominion Securities. Today, we're joined by my associate, Rob Smith, as well as one of my partners at the firm, James Kopp. James is a Vice President and Estate Planning Specialist with us. James, you've been with our firm for 13 years and 20 years in the industry. Thanks for joining us today.
Thanks for having me.
Now, James, we've seen a lot of our business owners and professional clients take a look at permanent insurance. Why is there so much interest in it these days?
Well, there comes a point in most business owners' lives and professional person's lives whereby they realize they're not going to spend all of their money during their lifetime. So the question then becomes, for the money that they're going to pass along to the next generation or perhaps to a charity, what's the best way to invest that? And when you look at the two main options, one being the stock market, oftentimes people don't like the volatility associated with investing in stocks, especially when you're older and you don't have that same time horizon whereby to recover from a recessionary period. On the other hand, for those people that like security, investing in fixed income investments such as GICs and bonds, right now there's a very low interest rate environment that we're in. And so the other option would be permanent life insurance. With permanent life insurance, the death benefit actually has a rate of return associated with it, given the premiums that one deposits into a policy. And the return on the death benefit oftentimes provide market level returns with much lower risk levels. And this works especially well with corporately owned life insurance policies, whereby the death benefit creates what's called a capital dividend account balance, with a capital dividend account being a notional account associated with all corporations. And this pays out the tax-free proceeds of a life insurance policy. And one other thing to make mention, with regards to the death benefit and the cash values inside of a corporately owned life insurance policy, it doesn't have any effect on the small business tax when it comes to corporations. And all of this combined can be an attractive investment vehicle for someone.
That's interesting. Now tell me, you don't get anything for nothing in this world. What are some downsides of having permanent insurance?
One downside to life insurance is taking out less insurance than is needed or that somebody wants in the future. And this becomes a problem because, as one gets older, there's a greater insurability risk that somebody isn't in as good of health as they were in the past. Secondly, another downside to insurance might be taking out too much insurance so that the premiums being deposited into a policy are putting a damper on one's cash flow, especially in retirement. So the way around this is that insurance recommendations aren't made in a vacuum. They're made using the results of a financial plan, for example, that can accurately pinpoint how much money is in excess of what somebody is going to spend during their lifetime. And again, taking a portion of that money that one isn't going to spend and reallocating it to a permanent life insurance policy.
So again, it's all part of planning process.
Exactly.
Now, Rob, do you have any questions for James?
Yeah, so James, for someone like me who, might be a year or two younger than Greg, when does it make sense to start looking at these policies, and what kind of circumstances should I be aware of or considering?
That's a really good question, Rob. So there's different types of insurance out there. One is term insurance, and term insurance works well if you're covering off debt, such as a mortgage, for example, or if there's a husband and wife and they want to use a policy for income replacement should one of them pass away prematurely. That can be started at any point in time. Term insurance is a very cheap, viable option to look after those types of needs. The other is disability. So in the event that one can't work due to illness or accident, then one's income is replaced with the disability policy. Again, that's something to take a look at as soon as possible. When it comes to permanent life insurance, though, that's more, I would say, a luxury, so to speak, meaning that, first of all, you want to make sure that you're maxing out your RSP contributions, you're maxing out your tax-free savings account, you're saving up for the retirement to find a lifestyle that you want. And so if there's anything over and above that that's needed in retirement, that's when one can look at permanent life insurance.
Well, James, that's great. Thank you very much for those insightful comments. And if our clients have questions, I'm glad to have you on my team to be able to answer them. For anybody else that is enjoying this today and you have other ideas that you'd like to hear about, by all means, pass them along. We're always looking for new topics to talk about. Thanks again, James, and I hope everybody has a wonderful day. Take care. Bye-bye.